A lot of times we're used to just picking the same benefit we had last year, putting in the same amount that we had last year, and I don't know that everybody knows that the rules have changed.
As we all know, regulatory requirements significantly influence accounting practices and the way we serve our small business clients. I'm excited to be joined by three distinguished experts in the tax and regulatory space. As always, there's a lot to unpack here. So Ron, what are the key new requirements that businesses should be ready for?
Yeah, that's a great question, Jody. And I keep thinking the Secure 2.0 Act is the gift that keeps on giving, right? So it was passed at the end of 2022. There are provisions that were effective immediately, and there are provisions that come into effect. And a few of them that just came into effect on January 1st was the mandatory automatic enrollment. So any retirement plan that's a new retirement plan after the enactment of the Act has to have automatic enrollment now with certain provisions. So employers have to have started that on January 1st, and they have to make sure they're enrolling their employees automatically if that rule applies to them. There's also another interesting opportunity for employees who are ages 60 to 63 to make extended catch-up contributions higher than the normal rate of catch-up contributions that are otherwise available. And it's actually 150% of the regular rate. So a great opportunity, right, to start talking about, taxpayers that may want to contribute more. They can start now and contribute more towards those later years in retirement. There's also an interesting one, the long-term part-time employees, which was a way for Congress to get more people into retirement plans earlier. So traditionally, you can hold someone out from a retirement plan for up to a year of service. Under this long-term part-time rule, if somebody works 500 hours in a year, it used to be in 3 consecutive years, you would have to allow them to participate in their retirement program. In 2025, that rule comes down to 2 years. It's important for employers to understand that, and accountants have an opportunity to talk to their clients, right, about making sure that those provisions are in place and they're ready for them.
Especially now, like it's tax season, right? Your clients are going to be in the office or you're going to be meeting with them. So I think those are definitely key things that we should be bringing up with our clients or our customers as they come in as opportunities.
I think for sure, because I think a lot of times we're used to just picking the same benefit we had last year, putting in the same amount that we had last year, and I don't know that everybody knows that the rules have changed. So I think it's a great opportunity for accountants and other tax professionals to have those conversations and say you might be eligible for the extra, for example.
Yeah, and to add to that, one more Secure 2.0 provision that has still yet to be implemented, it'll begin in 2027, is the Savers Match. And the Savers Match, it's still in the process of implementation, and IRS is still working on guidance for it. But essentially, if you fall within certain income limitations and you save up to $2,000 in a 401k or IRA-like account, the Treasury IRS will then deposit up to $1,000 to match that.
Are there specific guidance updates that have already been issued that you find noteworthy?
Some of the other guidance that we've got has been very helpful. So they've provided guidance on catch-up as Roth. So that was a big, it's a big issue, and it's probably one of the things that is paying for most of the other tax provisions in the Secure 2.0 Act. And that would be for any employee who earns more than $145,000 in wages from the same employer in the prior year. They would be subject to a new rule where they could only make their catch-up contributions as Roth. So it would cause immediate taxation, right? And that was going to provide a lot of income to pay for some of the other provisions in the bill. Well, that got delayed. So the IRS gave us guidance that delayed that until January 1st of 2026. So that was originally supposed to be effective in 24, is now delayed to 26. But we did get also some helpful guidance from that, which is that employers can now, as we're preparing for this rule, if an employee makes a pre-tax election to have their deductions pre-tax, the employer can automatically switch that over to Roth when they hit that limit, so that you don't have to stop contributions, reach out to your employees, get elections. These are high wage earners, right? So it's going to be a challenge for that. And those people probably want to make sure they get their contributions into the plan. We've also got some guidance on student loan matches, which allows an employer to make contributions into a retirement plan for employees who otherwise may not be capable of making those contributions because they're trying to pay off their student loan debt. And so the IRS gave us some guidance that allowed for implementation of that and it allows for some clarity on who's really eligible for that, for the qualified student loan payments. There was a question about, well, what if I'm a co-signer on a loan? Am I eligible for the qualified student loan payments, or does the loan have to be for myself? And the IRS made it clear that you can use the qualified student loan payments if you're a co-signer on the loan and you're obligated to pay on that loan, even if it's for a dependent. So it could be for you or for a dependent. And they've put some rules in place where there's certain certifications that employees need to make each year in order to be eligible for those student loan payments. But that was very, very helpful guidance that we were looking for.
And it's consistent with the deduction. So that's actually the same rule for claiming the deduction. So it's really nice, I think, that they've lined those things up, because I think sometimes the mismatches in the code and the guidance is really confusing for taxpayers.
With the student loan matching, I think the individual can contribute the match, or the employer can directly put the match in.
Yeah, the match will go into the plan, so that's a great point. The match will go into the retirement plan just like any other match for the employee. So they, again, get the benefit of, if they can't afford to contribute their own money into the plan, now that matching money, kind of similar to the Savers badge, yeah, that's now growing for retirement for that employee who may not otherwise been able to contribute to the plans. And I think it's important for accountants and CPAs to realize that they need to get comfortable talking about retirement with their clients, right? It may be something they've shied away from, it may not be part of their business, maybe it is. But if they're not talking to their clients about this, somebody else probably is, right? And there's great opportunities for tax savings. So if you have a small business owner starting to make money now, maybe they're hiring employees, they may be in a state that's subject to a state mandated retirement program. So it really is a great time as an accountant to really kind of embrace
that advisory role.
Yeah,
and really,
absolutely.
it's about becoming an advisor and more of an advisor, and kind of separating us a little bit from compliance and advisory. So whether we charge for it the same or different, it's the idea of us upping our game and really becoming that true small business advisor, as well as the individual tax advisor.
Yeah, absolutely.